Aunque muchas veces el retorno no es el principal factor para cerrar una transacción, estamos todos de acuerdo que hacer rendir la cartera motiva a seguir invirtiendo. Demos la bienvenida a Nelson Gray, quien estará compartiendo con nosotros sobre su experiencia administrando inversiones, cuáles fueron sus éxitos y fracasos y algunas recomendaciones para maximizar el valor de la cartera. Bienvenido, Nelson.
Thank you. That's the best introduction I haven't understood for a long time. I know there's a lot of cultural differences, so because I work in different parts of the world. And I know I'm going to take my jacket off, and I want to ask you if that's okay. Because I know that culturally things are different. I sold my business to some Germans, and if you took your jacket off, they kind of looked down at you because you were relaxing. But if you go to America, you take your jacket off, you're getting down to work. And if you're in Glasgow in Scotland and you take your jacket off, you're about to start a fight. I'm not deliberately going to start a fight, but who knows what's going to come out of my mouth over the next short period of time. I was asked to come and share what I have learned being a business angel over the last 20 years. And I said, yeah, I'm happy to tell you everything I've learned, but what do you want to do in the other 59 minutes? So I thought I'd tell you how this region and Scotland are actually quite closely connected through investment. And when I say region, I'm actually stretching the boundary a little bit, talking about Panama. Because we go back to 1690. Now, I wasn't actually there in 1690, but in 1690, the Scots decided that they wanted an empire. Everybody else had an empire in Europe, and the Scots decided they wanted one. It was like, we're going to have an Uber. Everybody's got to have an Uber these days, so this was going to be our empire. So they decided they would establish the colony of Caledonia on the Isthmus of Panama. And they'd have a colony there, and they'd take groups from the Pacific overland into the Atlantic and up to Europe. And to fund it, they invented crowdfunding. And they went round all the people in Scotland, and they gathered money to pay for this. And it actually took 50% of all the free cash in Scotland. 50% of all the cash. Now, I understand that was Scotland. There wasn't a lot of cash, but it was pretty much everything we had. And they set off, as entrepreneurial people do, without a business plan, without any research, without actually having visited the destination, without having actually talked to any customers. And they arrived in the paradise that was basically a swamp and proceeded to die in large numbers. What they hadn't taken into account was, of course, that Spain held all the intellectual property on this part of the world. You know, Spain owned the IP, so we weren't going to get any of that. So eventually, the thing collapsed, and Scotland was bankrupt. Literally, pretty much bankrupt. And that's what led to the Act of Union in 1709, when England took over Scotland. It was fundamentally an acqui-hire. You know, when you don't really like the company, but you like the management team because they'd be useful to you somewhere. So England acqui-hired Scotland in 1707 and sent all of the staff off to run the rest of their empires around the world. So Scots have been at it, this investing game, for a long time, clearly not very successfully. We don't take account of intellectual property, exits, or any of that. But over the years, we've learned a little bit more. So Scotland is 5 million people. The first significant angel group in Scotland started in 1992, and our national association the next year, 1993. We've got 20 groups, Archangel being the biggest. Over the years, Archangel has invested, last year we passed 100 million of angel money into 85 companies. Before Britex, £100 million was a lot of money. Now it's barely more than $100 million, so who cares? Every year, it's around about 27 million of angel investing is going into around about 60 companies. 75% of that is follow-on money now. We do a lot of follow-on investing. So that's the kind of background to Scotland. We've been doing it a little while. We've had some successes. We have a blank screen. It must be going the wrong way. It's in the wrong one. Oop. There we go. Okay, so there's good news. The good news is that business angel activity is alive and well and growing, and I was given these numbers for Excala, which look pretty impressive. The quote down below is from the European Union some years ago, who said business angel activity is essential for economic development, and that's been picked up globally. So now I'm being privileged to work with people starting business angel groups all over the world, from Vladivostok in eastern Russia through Kazakhstan, Middle East, Caribbean, and a whole bunch of other places. And the good news is everybody's pretty much the same. We're all doing the same sort of stuff. We all approach it in very similar ways. The numbers vary. They'll maybe put slides up and give you data, and your numbers might look smaller, but working in somewhere like Egypt, you spend $1 in Egypt, it's like spending $10 in America. So buying power has to be taken into account. So that's the good news. We're getting into business angel early stage investing in a big way. There is a problem. Now, in the UK, we'd call it the elephant in the room. It's kind of there, but nobody wants to talk about it. And the elephant in the room is this slide that you saw yesterday. And that is the apparent lack of, or the apparent failure rate. And you were told yesterday by Susan, and it's Susan's data, the latest surveys are showing 70%. The slides are all going to be available. Not quite these slides, because later on there's some personal data on there. I should have started off with the warning. At the beginning of some American cop shows, TV shows, there's a thing that comes up and says, none of these events are real, they're all made up. All of the companies mentioned on here are all made up, okay? Honest. Just in case it gets out. So, yeah, 70% is a really scary number. And what I want to talk about is how you get into the 9% that make money. But more importantly than that, I look at this a lot from an entrepreneur's point of view. And as an investor, I take on board and accept that I'm potentially going to lose 70% of the companies I invest in, which is uncomfortable. But I am very conscious of how much worse it is for the entrepreneur. Because I've got a portfolio just now of, 20 companies. The entrepreneur's got one. Their life depends on it working. So one of the reasons I like going through this stuff is, yes, it gives the angels a better return on investment, but it also helps the entrepreneurs be more successful as well. And I don't believe that 70% of the companies that failed to return cash had bad management, had bad business plans. I actually think that we angels maybe didn't do as good a job as we could have done to help those companies get through to an exit event and create entrepreneurial wealth. So we're going to cover that. So, these are the first lot of fictitious names. I've lost money on all of these. Okay, so these are my learning experiences. Expensive MBA. There's a couple down the bottom, which are fictitious, but I think it was talked about, somebody asked a question on that side of the room yesterday about companies that aren't performing. There's one down there, which today I got the stock transfer form for. I have about 7,000 shares in that company, and I am selling them to the founder for £1, which will be a tax write-off for me. That company has been around for 10 or 12 years. It's not going anywhere. It's not going to be an exit. Why not just give it back to the management team? And I can move on. Because although the company's still there, whilst the company's still there, I may not be putting money into it, but I kind of feel responsible for it. So every now and again, I think it's appropriate to clean house, move on, let the company go forward, not have to hang about reporting anything to me. So those are the kind of bad news stories. These are the good news. Managed to make money on all of these. Oregon down the side there is down as good news. Hoping that that's going to be an exit very soon, but we've had kind of 5 times our money back on dividends on that one. It's not a technology company, it builds timber frame houses. It bangs bits of wood together in a big shed. But it's exciting, it's got a 25 million turnover. Optos was the one that Susan mentioned yesterday. It wasn't 14 rounds of funding. No, it was 14 years and 16 rounds of funding. And then we floated it on the main stock market in London. And if you'd been a first rounder investor, you'd have got 55 times your money back before the tax breaks. A long, long time to keep it going. So I was in that for 9 years, which is a long time to keep going. VibTech is the opposite end of the exchange, 53 weeks investment to exit. Who the hell knows how when I went into all of these, I had no idea what the outcome was going to be. So the idea that I can pick winners, nonsensical. I'll tell you how we make money in a minute. So how do you get in the 9%? Well, first of all, understand the environment we're working in, because there's really good news out there for angel investors. Part of the good news is, that's probably too small to see. This is the proportion of technology exits, USA and Europe, that had VC funding before they had a successful exit. 32% of the exits recorded in last year had received VC funding before the exit. Only 32%. 68% exited profitably without having to go to a VC. And I think that's great, because it was driven by various forms of grant and angel investors working together. There is a great opportunity. You may be sitting there. We have very little resident VC in Scotland. We drive businesses ourselves to the exit event. More data on the exits last year. So 54% of the exits in technology last year were for $50 million or less. Now, actually, it'll be a much lower number than that, because people don't record and publish low exit numbers. And the vast majority of exits are actually for a lot less than that. I got some information a couple of years ago. US suggested that nearly 50% of exits in the US, all M&As, were for less than $10 million. Now that's on one hand, that's not very good, I'm not getting a unicorn exit. Yeah, but it's actually quite good, because it means that we business angels can afford to fund a company through to exit if we manage it properly. If we understand what the exit options are, we can build something within our own capital resources. So that's lesson number 1 of how to make money at being a business angel investor. Understand the reality of exits and not the headline numbers. And yes, we have had some big exits in Scotland. Skyscanner, which is down there, was sold last year for $1.4 billion out of Edinburgh. It was the 5th largest exit last year in technology, 3rd largest M&A transaction. There were no angels involved in it at all. So the second one that I think you have to do before you start is understand investment philosophy. Now, I'm not going to go through all of this story, but this is the story I use Optos, is why I am still an angel investor. Optos invented a device that scans the back of the eye. This little girl had a problem with her sight, was taken to a doctor, had the eye scanned, and using this technology, they detected a cancer in her eye. It would not have been detected without the invention of this technology that we funded. Her life was saved. It was nice to get the 11 times my money back on the deal. It's really nice to say we've actually saved people's lives every single day around the world using our technology. It's a huge emotional impact when you're an investor. You don't get that investing in property, frankly. So I think it's really important before you start investing to sit down and write down what it is you're going to invest in, what your rules are, how much you're going to put in, how much time you're going to spend. These are some of my rules. I do not invest by myself. I invest with others. I only invest through my group. I don't do convertible debt, ever. I know that might be controversial among some people, but I just don't do it. We don't need to, because nobody does it where I come from, unless it was a real bridge to something in a couple of months' time, but I just don't. We want sensible valuations, so we're looking for 25 to 30% of the equity when we first invest as a group of people. I invest small to start with, $10,000 to $25,000, and we crowd in as many people as we possibly can, and then we follow through on the ones that are being successful and we drop the ones that aren't. So we are planning on 3 to 8 follow-on rounds. Now that means we put a lot of angels into our deals. NTech, which is a camera device, the last round of funding we did, we have 47 angel investors in that deal now. No VCs at all. So I think if you work through and think about what it is that you want to do as an angel investor before you start, it's much easier to decide what deals you're going to do. I also ignore pretty much everything they do in Silicon Valley because I don't live there. I never compete for a deal. We have a very sharing environment in Scotland, so if 2 angel deals want to do a deal, we'll just split down the middle, because we never know. The reality is, round 1, we have no clue which is going to be a winner. Round 1 is only the money you're putting in the deal to have the right to do round 2 once the management have worked out what the hell they're doing. Until then, just share it. You know that 1 out of the 10 you're going to do is going to be a winner, but you have no idea which one of the 10 is, so why fight over the damn thing? Share it, get people in there. They've got to have some traction, some involvement with customers. They don't have to have sold something, but they have to have talked to people about price. So I'm jumping around a bit. I only invest in people I'm really excited about, or as a friend of mine said, I only invest in people that I'm willing to be in the shit with for the next 7 years. And if you aren't willing to go to the pub or have a drink with them in the evening after you've had a difficult board meeting, you shouldn't be investing in them either. And we only do teams. That comes with a bit of baggage. So I'm saying we need a team of 3. But I already know that if we have a team of 3, within 3 years, we're probably going to have to fire one of those founders. So that's already also built into our thinking. The biggest mistake many investors make, well, number 1, they put too much money into their first deal. Number 2, they don't sort out the management team when it stops working. Next lesson is rethink the investment process. So when I first started doing this and going out and talking about the investment process, I laid it out like this, just to explain it to people. You find a deal, you do some screening, you do the term sheet, the due diligence, the valuation, the legals, you do the investment, and then the exit's down here. And the exit's kind of hidden away down the bottom because it's a long way away, and I went a long time for that. And then after not having had any exits for a decade, I realized I was doing it wrong. And this is now my exit process. I put exit in the middle of the entire process, and every single element of the the slides are going to be available, so you don't have to worry too much. Every single thing in the process, I'm thinking exit. Before I look for deals, I'm thinking exit. You know, super drug discovery is going to take, billions to develop, so I'm not really terribly interested in it. Certain other sectors I know I can't fund because they're too capital intensive. I think energy was mentioned yesterday. So I'm already thinking before I look at the deals about exit. I'm thinking about screening. One of the early conversations with the entrepreneur is, so how are we going to sell this company? Because from day 1, I want the entrepreneur on the ride to creating wealth for him or her and me. The whole thing, term sheets, got exit terms in it, drag along, tag along, all of those provisions that help you drive an exit. The due diligence, we will ask about the exit. Who's actually going to buy this company? We'll come into that in a minute. So the whole process now centers around exit. I'm not forcing the exit, but I want to create something that is capable of exiting. So one slide on the exit due diligence process. The top bit asks for detailed exit analysis. I've stolen from Angel Group. I'm involved in Tech Coast Angels. They have a standard slide deck. They ask the entrepreneur to set out, name 5 people who might buy your company and what you have to look like and how much money and time it's going to take to look like that. Because most sections of the business plan simply say, we'll exit by an IPO or a trade sale. And we have no bloody clue who it's going to do, but it's bound to be great. Okay? So you get that information, and then you actually go and do some due diligence on it. You say, well, okay, you've named this company. Have they got any money? Have they ever actually bought a company before where you live? And, and have they done it in your geography? And you'll be surprised how often they haven't. I mean, I had an entrepreneur of a life science company came along to a board meeting, really pleased with himself. Turned out, without telling anybody on the board, he'd been talking for 6 months to this AIM-listed company about potential acquisition. And he just wanted to show off how smart he was. So at the board meeting, we Googled the company. The company is listed on the small market in London, AIM. It had a market capitalization of 29 million. It had 2 million in the bank, and it had just reported its first profit to the market of £300,000. There was no way ever that that company could buy us for £10 million. It didn't have the capitalization, it didn't have the money, and if they bought us, a pre-revenue company, it would tank their revenue. What a waste of time. He'd just probably given away all our trade secrets, that's all. So do some due diligence on it. Next point is there are no small deals. I get people coming along and saying, well, it's only a small deal, it's only 50,000, so why do we need all this legal stuff, and why have we got this complicated board structure, and blah, blah, blah. It's only $50,000. No, it's not. If it's going to work, it's only the down payment on $1 million investment. And whether it's $50,000 or $1 million, your time as investors is equally valuable. If it goes south, if the business is destroyed, you'll lose your money, but you're smart people, you can earn some more money. You'll never get your time back. The time you could have spent with your families, with your hobbies, with another entrepreneur, you'll never get that back. So never say it's a small deal. Every deal we do gets the same treatment in terms of due diligence review pretty much, and certainly the legals. Oops. Now, drip feeding. Giving entrepreneurs a little bit of money at a time against results. Entrepreneurs hate it. I am constantly being berated by entrepreneurs in Scotland who say, you give us too little money. If we were in America, we'd get millions and millions, and it'd be so much easier. And of course, that's complete garbage. But this is how this actually works. You put a little bit of money in and see what happens, and if they meet the targets, you put some more money in. And then you drop the ones that don't work. What is the result of that? The result of that is this. This is it's slightly old data. It's 79 investment companies, companies invested in by Archangel. They have lost 46% of the companies have closed and died. But they've only lost 14% of their stake money. Because when the thing stops working, they stop funding it. Put a little bit in, get it going, and keep going. And you keep funding the workers. So when somebody says 70% of the companies failed to return capital, that does not mean that the angels should have lost 70% of their capital. If you follow this results-driven funding model, and you plan it in advance. And we're planning the funding years ahead. Create choice in your investments. Too many companies, too many investors invest on a business plan that looks like this. Initial funding, and then an exit. Give us $250,000, and we can then exit to Google for $300 billion, or whatever the number is. Okay. And sometimes this is cultural. I know that in some places it is seen as weak to say, I'm going to need more money in 6 months' time or a year's time or whatever. So there's maybe some cultural issues I don't know about here. Now, the reality is more often like this. You have the initial funding, the second unplanned funding, the third unplanned funding, the fourth unplanned funding, and then the exit. Okay? So don't do this. This is what I think you should do. Every time you put the money in the company, regardless of what's in the business plan, you have the objective of achieving as many of 3 what I call steady states as you possibly can. You can't necessarily get to them all, but try and think about what you can get to. Number 1, with the money I'm putting in the company today, can I get to cash break even? Now, if you can get to cash break even, it's not necessarily a great company, but at least it's alive, and you can think about it. You can work out, you can pivot, you can do something else. Secondly, you create something that another funder is willing to invest in. Now, that might be yourself, or it might be a VC, or it might be another group of angels. That means you have to go out and understand what it is that you have to create that will enable people to come in and invest in your business, which may not be creating the watch. It may be that you've got to have 26 customers for the watch before a certain type of investor is willing to invest. So you have to do your homework as you would a customer of the watch. You have to do the homework thinking of the business as the product. What do I have to do to make this investor invest in me? And third, can you get to an exit offer? What do you have to create to get to an exit offer? And we spend quite a lot of time trying to talk to corporates about what we have to look like to be of interest to them. So, if you're selling a chemical company to DuPont, you've got to build a turnover of about $50 million before they'll talk to you. $50 million takes quite a lot of money to fund. If you talk to some of the techie companies, IBM, Microsoft, Autodesk, they seem to have a comfort spot around $25 to $35 million. So you can actually go out and find out what sort of companies they're buying, and you can work out how much capital it's going to take and how long it's going to take so that you look like something they're interested in. Now, if you have all of those, you've created choice. You're not heading for the toilet. You don't have to take the exit because you've got a choice of raising more money or simply growing cash. I came up with this diagram after reading a book about Drucker, who had a meeting in London in 2005 with 2 of 4 entrepreneurs that he'd invested in this company. 3 years previously, I think. And the entrepreneurs wanted to talk to their VC because they'd received an offer for the business. And it was the classic conversation. Do we take more money? Or do we grow organically? Or do we take this offer? And in the end, the company decided to take the offer. And the only dissenting voice on the board was, in fact, the representative of the venture capitalist. Now, that was the first exit of a small company called Skype for $2.5 billion, 2005. Now think about what that would be like sitting around your boardroom with your team of entrepreneurs. Should we take the offer for $2.5 billion? Should we go to the next level? Not so sure. That's what I mean about creating choice, but you have to do the research, and the entrepreneurs probably don't know how to do that research, but you can get them in the mind frame of doing it. And as I say, you don't have to take that exit. If the first exit's at 10, let's say 10 million, and somebody's willing to give you funding, then go to the next level. But do understand that exit values are not linear. The companies have these little sweet spots. So if you go past the sweet spot for your industry of, let's say, 10, 20 million, the next point that they'll buy you is no longer on your strategic value, but it's on your financial value. So you're going to have to invest a bucket load of money to be bought at 100 million. And a lot of stuff happens between there and there. So we play an envelope game. Don't know if you've heard of the envelope game with entrepreneurs who are reluctant about selling out too soon. It says, okay, we sell for 10 million. This envelope has $5 million in it, cash. And this envelope has $15 million in it, or nothing. Which envelope do you want? Focuses the mind somewhat. Oops. And post-investment. This is when the work really starts. I think lesson number one is it's really tempting when you're an angel investor to put somebody on the board who knows about the technology. I'd rather put somebody on the board at an appropriate time who knows how to do a transaction, who understands the exit process, who understands how to sell into corporates. So think about the skill base you're putting on there. Sometimes I worry about angels who put more domain experience on the board, because do you really think your entrepreneur doesn't have enough domain experience? Is that the weakness in the team? I'm not so sure. So you build those options for the exit, understand them, write down the exit strategy, and then revisit that exit strategy every 6 months or so at a formal board meeting. Keep the entrepreneurs and everybody focused on taking it forward. Track what's happening with the people you think you're going to buy. I was involved in a business that was doing a drug for diabetes. And when we started the business, there were 5 potential acquirers. Within 5 years, there was 1, because all the pharmaceutical companies were buying each other like crazy. You've got to track it, find out who's actually in the market. Keep all the people aligned. Talk to the entrepreneur that they really are willing to exit, and talk to your fellow investors that they are also similarly minded. I think somebody here was talking about, are you chasing unicorns? Are you chasing gazelles? Unicorn exit 1 in 500 probably. All my exits are the smaller category. Think exit about every decision. People talk about going after the low-hanging fruit when they're looking for sales. Sometimes the low-hanging fruit is there because nobody wants to eat it. Sometimes you actually have to go after the difficult sales because those are the ones that your potential acquirer cares about. I talked to an M&A guy for a telecoms company in Hong Kong. He said, we are often approached by companies who would be interesting for us to buy, but their customers are in the wrong place. They have customers in Vietnam. We don't service the Vietnamese market. If we buy that company, we're going to have to shut that operation down. And that's going to make us look weak. Because the market is going to see us, this big telecoms company, shutting down in a country. And they're not going to understand that it's for strategic reasons. They'll think we're weak, particularly in an Asian culture. So think about going after the customers that customers really care about. The worst deal ever. Okay? Well, there's loads of bad deals. There was a deal I read about, it was a VC deal, I can't remember the name of the company, but Groupon had just bought a company for nothing, or $1, about 3-4 weeks ago. It had previously been valued at $5 billion, having taken in about $2 billion of funding. That sounds like a pretty bad deal. But actually, I don't think that's the worst deal. This is the deal you really don't want to do. Now, I have changed the photograph from the person involved, because Susan would know the person involved. and I have, but the name's probably the same. And this guy showed me this email that he keeps in. He's a very successful business angel in America. And he showed me an email. We were actually in Germany together. He keeps it in his wallet just to remind him how clever he isn't. He got an email from a former employee. I'm in this business, employee number 7. I think you should invest in it. And Dave sends an email back, says, that sounds really interesting, keep me informed. Which means, go away, I'm too busy to talk to you. $100,000 investment would have been $42 million profit on flotation. That's the worst deal ever. It's the one you don't do. So when you're sitting there worried about, should I do the deal? It's my first deal. I'm not really sure. Just remember this. You're going to wake up one day, yeah, you may have lost your 100,000. That would be a pain in the ass. But I don't know how I'd feel about losing the 42 million I could have had if I'd just been just a little bit more brave. I'd taken that brave pill just before I went off to the meeting. So, strategic angel investing, it's a team sport. Well, I think everybody here knows that. You're forming groups, you're forming networks. Don't do it by yourself. Do a little bit of investing and do lots of it. Don't compete for the deals. Be capital efficient. Build strategic value. Don't chase the EBITDA profit turnover multiple thing. I just don't have enough money for that. Think about the funding from start to finish. Do not do a deal that needs $1 million in 2 years' time if you have no clue where the $1 million is going to come from. Plan the exit before we start. I don't mean down to the nth detail that it's going to be bought by this company, but at least think what the company's got to look like and where it's got to operate. Drive the investment post-exit. Don't just let it wander off. And create this strategic acquirer value. Understand what it is that people are going to buy as the company, thinking of the company as the product that you're going forward with. There you go. Thank you very much. You want some?
Si alguien tiene preguntas con Nelson, tenemos 5 minutos que lo podemos aprovechar que está acá, así que aprovechemos, que viene desde lejos, desde Escocia. ¿Alguien? ¿Alguna pregunta para Nelson? Susan.
You're not allowed to ask questions.
This is kind of a fight.
I'll put my jacket back on.
No, you're not. I'll take my sweater off, okay? We'll do that. We'll get into fisticuffs. No, I actually want to agree with you.
Thank you.
You're welcome.
God, that's a first.
So nice to know somebody well. I want to load on to your comment about the smaller deals and doing that we did a study a few years ago and looked at deals that were between $1 and $10 million that were raised and $10 and $100 million that were raised in the theory that the 10 to 100 million is most likely with venture capital. And we looked at the M&A, the merger and acquisition exits, not IPOs because those are a pipe dream. The exits for the companies that raised 1 to 10 million were 7 times better than the ones that were raising 10 to 100 million. And when you think about it, you think, well, that doesn't make any sense. But it does make complete sense because if the company raises 5 million and they get an offer to be bought for 50, that's a 10x return just on the money itself. That's nice. And it's way easier for an Amazon, a Google, whoever you're talking about, to buy a company for 50 million. It's an afterthought almost for them to do that than it is for a company that's raised 50 million and has to exit at 500 million to give that same 10x. We also know statistically that when VCs come in and start investing, it adds 3 to 5 years to the exit because they do have to grow the company that much more. So when we look at deals, we look at deals that have that capital requirement somewhere between 5 and 20 million in that range, And we look for where they've got an absolutely sweet spot for exit by being sold in a fairly short time frame. So I'm agreeing with you.
That's great. I'm pleased.
Yeah.
Thank you. Hi, Nelson. My question would be, what is the most common pattern that you have found on those companies the startups that you invested in that had a successful exit, and the common pattern on those ones that you did not get an exit?
Like almost every question when somebody asks you about business angel, the answer is, it depends. Because of I'm a great believer that communities should, I think this was said yesterday as well, communities should invest in what you're strong at locally. In Scotland, I certainly have done very little web tech type investing in Scotland. It's heavy IP, it's science, it's technology, it's real software, it's medical devices. So they don't work because the science doesn't work. Nothing you can do about it. But at the end of the day, the reason is you haven't sold any product. It hasn't got traction with the customers. And actually, you can probably then bring that back to your management team, don't know how to engage with the marketplace. They probably haven't even worked out who the real customer is. And very, very often in technology companies, you go and talk to the founders, and they confuse users with customers. The customer is the person who signs the check. And if you're writing software for the banking industry, then there may be loads of users who love your software, but your customer is the director of IT for the bank. And the last thing he wants is more work to do. So he's going to push you back. So it's getting in there and understanding who the person is that's really going to sign the check when they order. People don't spend enough time doing that.
Okay, we have a last question down there.
2 questions. Why you don't like convertible notes? And the second one is, what kind of method do you use for valuations?
Okay, why don't I like convertible notes? Because I don't think I get value out of convertible notes. If I invest in a company today, then I really want that company to double its value over the next 12 months, at least, because of the input that we're going to put in there, our help, the effort, and all the rest of it. This company is going to change a lot in 12 months. And I rarely see the opportunity in a convertible note to get 100% value increase in a year. Most of the time, convertible notes are put in there, oh, it's simpler because we don't have to do valuation, or the legals are simpler. Well, we've got 20 angel groups in Scotland. We all use the same legals. We've got a standard set of legals everybody uses. It's dead easy. And valuation, it's made into a really complicated problem. But it isn't. It's really easy. Day one, the company isn't worth anything. If you go back to that graph, 70% of the investments that are made when they're closed are still worth nothing. But we don't know which ones they're going to be. The only time you know whether you get your valuation right is when you make an exit. And if you make a really, really big exit, then you undervalue the company and blah, blah, blah. So basically, here's my valuation method. How much money do you want? We're going to take 25% of the equity. That combination drives the value. Dead easy.
Thank you very much, Nelson. Un aplauso, por favor.